Okay, today we are going to deal with something new that we didn't cover at second year level. We're going to look at complex groups. Specifically, we're going to look at vertical groups. In second year, all we had was a parent with a subsidiary. That's all we had in second year. Now in third year, we're going to have more complicated groups with multiple subsidiaries, with associates, with joint ventures, with joint operations. But we're going to start today by looking at vertical groups. And vertical groups arise where the subsidiary also has a subsidiary. The subsidiary also has a subsidiary. So in my example here, the parent owns 80% of the subsidiary. The subsidiary has a subsidiary. They own 60% of that subsidiary. And so therefore, the parent effectively owns 48% of the subsidiary, which is 80 times 60. We are never going to use that effective holding in that way. When I studied at varsity, I was taught to use the effective holding method to do vertical groups. You will never use the effective holding method. So we're going to just do it in two pieces. So that's just for you to see effectively what we hold, and then to show you that because we only own 48% of this vertical subsidiary, the sub-subsidiary, that there's an NCI or multiple NCIs who own the other 52%. And that is exactly the issue that we have when we have vertical groups. We have an extra NCI. So let's just have a look at these NCIs. The parent owns 80% of the sub. So this NCI of the sub, sorry, I didn't want to use. This NCI of the sub, he owns 20% of that sub. Yeah? So this NCI here owns 20% of that subsidiary. The subsidiary owns 60% of the sub-subsidiary. So there's an NCI here. He's the sub-subsidiary's NCI. He owns 40% of the sub-subsidiary. And then we have this extra bit because this NCI, this guy over here, he not only does he own 20% of S, but he also owns 20% of 60% of SS because he owns everything that S owns. So because he owns 20% of S, he also owns 20% of 60% of SS. If we do that calculation, it means that this guy, Mr. S, he owns 12% of SS. This guy here, Mr. SS, owns 40% of SS. So together they own 52% of SS. And then you can see why the parent actually only owns the remaining 48%. But when we do vertical groups, we have two subsidiaries. So we have two NCIs. But because it's a vertical group, we have the extra piece. And this is the most important thing to remember here is this extra piece of NCI, this extra NCI here. And that's the most important piece to remember is this extra NCI. Whenever you're doing NCI calcs with a vertical group, you have your two normal NCIs and the extra NCI. So that's the first thing to remember with vertical groups. The second thing to remember or to look at with vertical groups, and it's only these two things that are different really. So the one is drawing our picture and understanding who owns what and remembering that there's this extra piece. And then the second one is looking at the acquisition entries. Remember in our very first lecture, we looked at acquisition entries. We said IFRS 3 is the acquisition entry where we acquire control. Acquisition transaction. When we have vertical groups, we could have a situation where we have two acquisitions and two goodwills. Look at this case. The parent bought the subsidiary in 2010. The first acquisition transaction happened in the group in 2010, and there would have been a goodwill number in 2010. Then, in 2013, the subsidiary bought shares in the sub-subsidiary. The second acquisition entry happened in 2013 from a group perspective, and that second acquisition entry, which was when our existing group, P&S, then bought SS. It was a second acquisition entry, and so we land up having 2 acquisitions and 2 goodwills. Yeah? So depending on my acquisition date, I could land up having 2 acquisitions and 2 goodwills, or look at the second scenario. In the second scenario, the first acquisition takes place in 2013. In 2013, there was a little mini group happening here where the subsidiary bought SS. That transaction is not part of my group because my group is the parent. Yeah? It's not part of my group. So when that transaction happened, S wasn't part of my group. It is not a transaction that occurred in my group. The second transaction occurs. It occurs in 2014. In 2014, I acquired a group of companies. When I acquired S, I acquired S Group, which was made up of S and SS. Yeah? So there is one acquisition transaction and one goodwill, which was when P acquired S Group, S and SS. It's very important that you are able to determine these dates correctly and that you're able to determine which one you've got, because the calculations that you're going to do are different for each one. So I'm going to take you through a couple of examples. The first example is example 3.3 in your study guide. It's on page 105. 105. And this example on page 105 is the first example with the first sort of dates, which is that there are 2 acquisition transactions. The parent bought the subsidiary, and then later on, the subsidiary bought the sub-subsidiary. So we have very imaginative names, A, B, and C. And immediately when you get given a trial balance, you can see whether it's a vertical group or not from the cascading of the investments. So we can see them over here. Look, investment. Yeah. So A has an investment in B, B has an investment in C. You can see them cascading. If it was a horizontal group, horizontal groups are groups that look like this, A, B, C, then A owns both of the subsidiaries, then the 2 numbers would both be under A's trial balance. So when we see this cascading effect, we know that we have not got that situation. What we've got is a vertical group, which looks like this. A, B, C, like that. Yeah? Okay. So I tried to squeeze everything in so that we could see the information here on the side, but we'll work through it like that. All right, so if we look at the additional information, A purchased 98,000 shares in B. I immediately work out percentage. B has 140,000 shares. A bought 98 of 140. A bought 70% of B. And they bought it on the 1st of January 2000. At that stage, B's retained earnings was 90. They acquired control. They always need to tell you if you acquired control, because remember, control isn't necessarily a result of voting. So it could be that we have the majority of the shares, but that we don't have control. The fair values of assets and liabilities were considered to be equal to carrying amount. So no adjustments to be made. So at 1 January, I can do a simple acquisition calc, isn't it? And here it is. At 1 Jan 2000, retained earnings 90, share capital 140, 230. NCI 20%, leaving me with 161. I paid 165. I have goodwill of 4. Yeah? Look here, I paid 165. I have goodwill of 4. So first acquisition entry gives me a goodwill of 4 and an NCI of 69. Yeah, 69. Then, let me actually, oh, it doesn't matter. I was going to say, but I don't think it'll go any lighter. There's my NCI. Then, on the 1st of January 2001, B acquired 127,500 shares in C. If I look at C's share capital, they've got 150,000 shares. So 127,500 divided by 150 is 85%. At that date, and the retained earnings was 120. And everything else is fine. There's no adjustments. So second acquisition entry. Second acquisition entry. Share capital of 150, retained earnings of 120 to 70. NCI of 15%, 40.5. We acquired 85%, 229.5, and we paid 232. 232. And we landed up with goodwill of 2.5. It's important now, the first time we're going to see something about this vertical extra piece. Do you agree that if I look at the picture, where's my first picture, my very first picture that I have? Well, if I looked at the picture, and the picture would look like this, there's this extra NCI who also bought, let me actually draw it for this one. Add. Okay, so my picture looks like this. B bought C. They bought 85%. There's a guy here, an NCI, who owns the other 15. No, sorry, there's a guy here, an NCI, who owns the other 15. The parent owns 80%, no, it was 70% of B. So this NCI owns 30% of B. When this transaction happened, here, I've identified goodwill of 2,500. 2,500. So we paid 2,500 of goodwill for the acquisition of C. It's partial goodwill method. So the goodwill is only B. They don't have goodwill. No goodwill. The problem is, of course, that when I'm preparing financial statements up here, when I look further up the group, this goodwill, 70% belongs to this company and 30% belongs to this NCI. Yeah? And so therefore I have to make that adjustment for that goodwill. So 2,500 times 30% is 750. I've got to give them 750 of goodwill, and then I am only left with 1,750 of goodwill. Yeah? All right. So let's have a look. That's my calculations. Do you agree? So the goodwill that I expect to see is my 4 plus my share of the 2.5. All right. Let's have a look at the solution. Here's my goodwill. Goodwill in my statement of financial position is my 4 when A bought B plus my share when B bought C, 1,750. Yeah? Because the other piece I must give to NCI. Non-controlling interests is 42 plus 28,560. If I go back here. Comes off the analysis. Sorry, let me take you through to the analysis. These numbers, 42, 28,560 and 22,050, come from the analysis. But on the analysis, I'm going to show you the breakdown. when they do the analysis, they always work upwards. I don't recommend that you use an analysis to do the calculation. But I'm going to show it to you anyway so that you can interpret an analysis if you see it. So here you see the acquisition of C first. So they work from the bottom up. So they will do the acquisition of C first. Here's the acquisition of C, and there was the goodwill, 2,500 rand. Then, since retained earnings was 90, of which the parent gets 76 and the NCI gets the other 13. Profit for the year was 147. The parent gets 124, the NCI gets 22. And there was a dividend paid of 35, which the parent gets 29 and the NCI gets 5,250. If I carry on down the analysis then, what we'll see is those numbers flowing through here so we can see the extra piece. So we see that the retained earnings is coming through here and that we're giving NCI their share of that retained earnings. Do you see? Also, the since acquisition retained earnings is coming through here and we're giving this NCI their 30% share. There's the extra bits coming through over there. In the current year's profit, the current year's profit for C, which was the profit less the dividend, is coming through here of 95, and we're giving the NCI the extra bit. So there's all the extra bits of profit that are coming through that are being given to the NCI. Yeah. So every time you do a calculation, you must make sure to do all the extra bits with the profit. Here's the journals. So if we look at the journals, what you'll see in the journals are the journals for the extra bits, isn't it? So our journals look the same as consolidation journals always looked. Elimination entry, retained earnings going to NCI, profit for the current year going to NCI, dividend elimination, same entry that we always see. Then for the second subsidiary, elimination entry, on acquisition elimination entry, their share of the profits since acquisition to beginning of year. Then the extra piece. Here's the extra piece, the 85 times 30. So here is the extra piece of the profit, the 30% times the 85% going to the NCI. Here's the goodwill, the extra piece of the goodwill, the 85% times the 30% once again. And then over here is just the current year's profit and the extra piece going to the NCI. So we can see all the extra pieces, the 28, the 750 and the 22, all going to NCI in our statement, in our journals. If we look at them on the analysis, I wouldn't necessarily do an analysis. I would just find the numbers. There's the 22. There's the extra piece. Sorry, this is not an extra piece, isn't it? I'm not even going to do that. I just want to do the extra pieces. There's the extra piece, the 22. And down here, no, that's not the extra piece. That's the NCI, the normal NCI. See, that one is just normal NCI. I just want to do the extra pieces. The extra pieces are down here. There's the 22, the 750, and the 28. These are the three extra pieces. Extra piece beginning of year, extra piece for the goodwill, extra piece for the current year. Yeah. So what we see, if I just go back to this example, is an example where we had a vertical group that consisted of two acquisition transactions. There's my two acquisition transactions. Two acquisition transactions land up having two goodwills. I must remember to give the bottom subsidiaries goodwill a piece of it to that extra NCI because I don't own all of it, just to get that bit out. Then I must remember to do the extra pieces of profit. So whatever profit arose in the underlying company, which in this case was these numbers, retained earnings since, current year profit, and dividend and goodwill. Whatever profits arose in the underlying company, the very bottom company, must come through, and I must give those extra pieces to that NCI, and these are just the extra pieces. These are the 30% of the 85%, because if you see what's flowing down, I'm flowing down 85%, and that 85% is coming in here into the 100% column, and then I'm taking a further 30% off that number, and that's the number, the extra bit of NCI coming through there. Okay, so that's the first example, example 3.3, which is an example of a vertical group that was comprised where the dates are sequential, and so therefore there are two acquisition transactions. Example 3.4 is a similar example, but example 3.4, sorry, I'm already at the solution. Did I have the solution first? Oh no, here it is. Example 3.4 says, use the same information as example 3.3, but now assume that the dates change a bit. So assume that A purchased B in January 03, later. B acquired C January 01. So B acquisition of C doesn't change. So here was my B acquisition of C, and you can see that it doesn't change at all. Yeah. The only difference now is because my acquisition happened later, this 2.5 of goodwill is not going onto my balance sheet at all. Yeah? Because remember now, the dates are the other way around. If I look at the picture now, A acquired B and C group. So that's how that acquisition happened. A acquired BC group. And so because A acquired BC group, it's one acquisition, one goodwill. Yeah? And when I do the acquisition, when I do my calculation, so if I do this calculation over here, on AC calc, my on AC calc must show that I've acquired a group. So I'm going to show you how that calc works, that I'm showing that I acquired a group. So this bottom bit stayed exactly the same as it was before, but remember, of course, that we are not taking this goodwill into our financial position at all. Then, at the top here, A purchased 98,000 shares the 1st of January. If you go back and look at your trial balance, you'll see that the 1st of January, the retained earnings was 190. Share capital was 140. And now I must remember that I'm acquiring a group. So I must bring in the since acquisition reserves of the subsidiary. So if I just look at my picture over here, sorry, let me look here again. What was the number here? 120 was retained earnings. Let me just go back a couple of pages. Question. Okay. Retained earnings at beginning of year for C was 210. 210. Okay. So if I just go forward. I've gone too far forward, have I? Yes. That was the picture that I wanted, this one here. Okay. C, when B acquired C, retained earnings was 120. But when A acquired the group, retained earnings was 210. So the retained earnings has increased by 90. Yeah. B's share of that is 85%. So 85% of 90 is 76,500. That 76,500 is what I must bring in on acquisition, because I've acquired a group. This group includes the since acquisition movements or reserves of C. So when I do my calculation over here, you'll see that I've brought in a 76,500. This 76,500 is C, the since acquisition of C. Let's look at that calc again. C had a retained earnings of 120 when B bought C. But when A bought into the group, the retained earnings was 210. So the retained earnings have increased by 90 in the group, in the little mini group, in this little mini group over here. Retained earnings have increased by 90. So our 85% share, B's 85% share of that is 76,500. I'm acquiring a group. So over here, I must bring in the 76,500. Then, the other thing I'm going to bring in, listen carefully because it can be a little bit confusing, is I'm going to bring in the goodwill. Because included in the assets of B is an investment in C. That investment in C is overstated. It exceeds assets minus liabilities by 2.5. Look, when I first bought the group, I recorded that at 232. But the assets and liabilities of C were only 229.5, my share. So I overstated this investment by 2.5. So when I'm looking at fair value of assets and liabilities, my assets and liabilities are overstated. And so then I must remove the goodwill from the top there. Okay, so when I have dates that don't follow each other, but dates that precede each other, as they did here, whatever goodwill or bargain I work out down here, I reverse up here. Yeah? Why is that? Because my investment in C is sitting in B's books. It's part of the assets and liabilities that I'm acquiring of B. And it is overstated by the 2.5 million rand because it is goodwill. I paid more on acquisition than what the asset was worth. So I must reverse that goodwill over here. So then when I look at what is the value of what I've bought, the value of what I've bought when A buys B and C is 404. 140 for B plus 190 for B, less 2.5 for B because the investment that's in their books is overstated. Plus the since acquisition increase in the value of that subsidiary, 76,500, gives me 404. I take off NCI, 121. I'm left with what I paid, 282.8, my 85% share. Sorry, my 70%. I paid 165, and I land up with a big bargain. A big bargain. So if we look at those numbers again, I bought a group, so I must bring in the since acquisition movements in reserves. That's the pink. I must adjust for bargain or goodwill because that was an indication that my investment was more or less than assets and liabilities. And remember, on acquisition, I want to get to fair value of assets and liabilities. I adjust for goodwill. I land on 404. NCI is 30%. My share, 282.8. I paid 165. I have a bargain of 117.8. If I look at the solution, what you will see is no goodwill. No goodwill. I don't expect to see any goodwill. But in the statement of P&L, which is where, there isn't a P&L. Is there no P&L? Let me look again. Yeah, I don't know. Maybe it's further down here. Here we go. It's not in P&L. It's in retained earnings. Sorry, that bargain is already sitting in retained earnings because of the dates. Retained earnings. No, it wouldn't be. It would be in bargain. It would be in P&L. It was in the current year. Oh, you know what it is? It's in here. Sorry, I'm expecting to see a separate number, but it won't be a separate number. It's sitting in there. Calc 3. Let's go have a look at Calc 3. No. Calc 3, there it is. Bargain purchase, 117,800. 117,800. What you'll see is that they do a funny thing with the where they work out a slightly different bargain. They work out a bargain for C, because when they do the analysis as at the date that it became part of the group. So they do the analysis not when B bought C, but when A bought B and C. And so we landed up with a goodwill of 2.5, which we pulled through. They land up with this 74. But their 74, if I just go back here, is really just these two numbers. 76.5 less 2.5 is the 74. So these two numbers over here ties up to their 74 that they've got, that they adjust by. But this is, I think, a preferable way to do the calculation. But it's the same number. You can see it's the 74. So yeah, there's the 74, and they get to the 117,800, which is the number that we got to. Okay, so pro forma journal entries, they have a piece of bargain there, and then they reverse it here. Do you see? So when they record the first journal, they land up with a bargain, but then it gets reversed here. Our journal would have landed up with an asset, a goodwill, which we would have reversed here. It's the same thing. And then we land up with the true bargain purchase of 117,800. They then have the extra pieces, and the extra pieces are the same as what they were before, because the extra pieces have nothing to do with the dates of the acquisitions. So here's this extra piece of profit, the 85, the 28,560, which is the same that we saw earlier. We're just giving NCI their share. And then further up, I think, is the other bits. The other bits of profit are hiding up there in this entry over here already. Yeah, the other bits of profit are already sitting in this acquisition entry over here. Okay, so that's a vertical group. If I just go back to the beginning. In a vertical group, there are two things, and only two things you need to worry about. The first thing is the extra NCI. Just the fact that you have two subsidiaries means you have two NCIs. But the fact that you have a vertical subsidiary means you have an extra piece of NCI, this extra 12% that sticks out the side there. Because we own 80 of 60, and they own the other 40, so we own effectively 48, they own 40, so we short the 12, which is this extra bit of NCI. So that's your first calculation, or the first thing to remember. Whenever we're giving NCI pieces of profit, retained earnings, mark-to-market, since acquisition, current year, dividends, whenever we're doing those bits, we must remember this extra NCI. Then, the second thing to look at is the dates. Do I have one acquisition transaction or two acquisition transactions? If I have two, if the dates succeed each other, follow each other, then I have two goodwill numbers. They both land up in my statement of financial position. I must just remember to adjust this bottom goodwill and give NCI their piece. If I have dates that are in reverse, in other words, the bottom acquisition happened first, then I have one acquisition transaction and one goodwill or one bargain, which is what we saw. So the examples are 3.3 for the dates that follow, and then 3.4 for the dates that don't follow. Now, there's no assignment question that deals with vertical groups. So what I want you to do is I want you to have a look at question 3.5 in your study guides. It is, or example 3.5, it's on page 117. It's an example of a vertical group. We can see immediately on the face of the trial balance that it is a vertical group. There's the cascading effect of the investments. And they say to you actually that it was on the same day, the transaction. So when the transaction's on the same day, it doesn't really make too much of a difference. You can do it either way. And they ask you, there's a couple of intercompany transactions, you just need to be a bit careful with those, and they ask you to prepare consolidated financial statements. So that's what I would like you to do so that you can practice. So I'd like you to start off with a template. Yeah, a template. The template will look like this. It will have a statement of financial position. There's all my assets and liabilities, which you can get off the trial balance. There's a P&L. The P&L starts with profit for the year because the trial balance doesn't have any more detail than profit for the year. Here it is, profit for the year. So sometimes the trial balance will have revenue, cost of sales, other expenses, other income, whatever. This one doesn't even have tax. It just starts with profit for the year straight away. And then I need you to prepare a statement of changes in equity. The most difficult thing or part of the question, I think, because those two numbers that I've highlighted in yellow, the 9228,320 and the 1625,400, are worth a lot of marks. Okay, so question 3.5, example 3.5, I'd like you to stop now, take some time and actually do the question. If you don't want to actually, or if you don't have time to do all the statements, then what I would like you to do is to at least do all the calculations. So when I'm talking about calculations, I'm talking about this. This is the calculations that I have done for the group. So let me show you my calculation. You're going to get a fright when you see it, but this is the calculation, right? This is the acquisition, the picture with the acquisition entries, and then this is my movements, isn't it? My movements from acquisition to beginning to end, and giving NCIs all the shares, right? So you need to do all the calculations so that you can then go and check the numbers in the solution to check if your numbers would have come back to those numbers, isn't it? So that's what I want you to do. So example 3.5, if you've got the time now, set up your financial position, your P&L, your statement of changes in equity, and do the question in full. If you don't have the time, then at least do all the calculations, including the NCI numbers and the retained earnings numbers, and go check to see if you can get back to the numbers that they are then showing in the solution.